Hi, and welcome to our year-end Fireside Chat. Our Fireside Chats are designed to help our clients and friends get a deeper understanding or a fresh perspective on a timely concept by hearing from some of our trusted partners who do great work for our clients. As we're just wrapping up our fall review season, we're focusing on tax planning and year-end action items. I'm thrilled to share the screen with Logan and Claire from Vivify. The team at Vivify is focused on simplifying the tax preparation, filing, and education process for their clients. They help many of our clients with their tax prep and filing while collaborating with me and the rest of the Pleasant Street Wealth team to deliver tax planning for our mutual clients year round. What I love about Claire, Logan, and the Vivify team is first and foremost that they do great work. They value the team approach to servicing clients, ensuring all trusted advisors are on the same page, and focus on serving the client first. And they're also very clear about who they do their best work for. So with that, I'll let Logan and Claire introduce Vivify to the folks who've not met them yet.
Thank you so
Thank
much.
you.
I would also like to point out that we actually have a fire for
This
the
is our fire.
fireside chat. So
I like that. I thought
we're
about trying to
setting
get a
the,
Zoom background,
setting
but
the
I
bar
couldn't get a
high.
good one. Yeah, nice.
Setting the bar high for your first fireside chat.
Yeah.
So thank you so much for having us. We are going to share just a quick little slide deck to introduce ourselves.
First, kick off with you.
Let's talk about me first. So I am Logan Holman. I'm a CPA. I've been in the public accounting world for my whole career. I started at one of the big four accounting firms, and then I went to a regional firm and was a tax manager there for high net worth families, privately held companies. And I loved my work there, but Claire convinced me to start our own firm. And by having our own firm, we can really lean into serving clients exactly the way we want, which I think Claire and I are both really passionate about. I love traveling with my wife. And one of the last points on here, I skip pleasantries. So I think taxes are very personal, and it's something that I actually like about them because while people don't always like talking about personal things, I really want to make it comfortable and just let people feel at ease when they're talking about it.
Yeah. Okay. And next for me, my name is Claire Gallen. I was formerly a financial advisor like Taylor before jumping into more of the CPA side of my credentials and starting the firm with Logan. We are broadcasting live from my house. It's a kind of late 1800s, early 1900s historic home. And so the clicking that you might have heard at the beginning was my dog walking around, and you might hear some shrieks from my little toddlers downstairs. I have two baby girls named Corrine and Julia. And then I also, more about me, I love to run. I love to eat sugar. The two go hand in hand. Yeah, and I'm so excited to be here. We both just love taxes.
Yeah.
And especially where taxes and financial planning overlap. So that's really why we're here today. On the Vivify side, we do tax prep and planning for individuals, whereas Taylor and Taylor's team is on the wealth advice side, and that overlap is that what we say is a more vivified approach to your financial journey. And so as part of your tax preparation process, we're really making sure that we implement the financial planning procedures that Taylor is so intricately deploying on your behalf, and also keeping those lines of communication open with the financial advisor. Yep. And then last but not least, if you're interested in learning more about Vivify, go to usevivify.com. And then, of course, if you're interested in working with us, talk to Taylor and he'll get you connected to us, but also click the Get Started button in the right-hand corner for a virtual intake. Okay, Taylor, we're ready for the question.
All right. So yeah, thank you both for being here. Really excited to get into this. So, one thing that I know both of our teams are really passionate about is planning. And for most people, when it comes to tax planning, they really think of it as like an action item to do in February, March, and April. So, you know, I guess for both of our teams, tax planning is a year-round sport in the fact that we're constantly communicating and making sure our clients are staying ahead of this stuff. So as we head into the end of the year, what are some of the key action items that our clients should be thinking about right now?
You want me to start?
Go
I'll
for it.
start. We can both answer. So I think that I totally agree with you. Sometimes if you wait until February or March to think about taxes, it's really just reactionary and saying, I hope I did the right things. So we really say that taxes are a year-round process. Some of the things that people might think about as we get closer to December 31st are you maxing out your retirement accounts? Is your health savings account something that you can look into and make sure you're taking advantage of that? Certain charity or deductions that you might be able to take advantage of, or credits that you can do before the end of the year.
So that includes making sure you've made 529 contributions, any charitable contributions, 401k contributions through work, though very specifically the IRA contributions and HSA contributions don't necessarily need to be made until 4/15 or when you file your taxes, but make sure you're looking into everything else. In addition, I really love to talk about becoming organized for tax season, specifically with making sure that you are collecting all of the relevant tax forms. A lot of clients, when they come to us, they'll be missing a tax form and kind of expect that their CPA is clairvoyant and figuring out exactly what's missing, which sometimes happens and sometimes doesn't. So think of maybe creating a list, and Taylor actually does a lot of this through the softwares that he uses and the guidance that he provides through tax planning, but create a list of your different financial accounts, maybe old 401ks that you had at the beginning of the year and where they've moved at the end of the year. And then from there, I would say check those accounts to see if you have a tax form that you need to provide to your CPA, as well as what else? Any tax strategies that you've done throughout the year with Taylor, write those out. For instance, backdoor Roth conversions or donor advised fund contributions, and make sure that you are communicating those to your CPA.
A lot of times too, if you go through the process of writing out your accounts and you're not feeling that pressure of, oh my goodness, it's March 29th, I need to do this. It actually helps you think of, oh wait, I missed this account. Or you can sit back and say, oh, while I'm logged into this account, I noticed my beneficiary needs updated. It really is just one piece of overall financial planning and wellness that you should definitely touch base on throughout the year.
Yeah, at least once a year. Yeah.
Yeah, that's very, very good advice. And yeah, for our clients, we use the tax report and tax letter to make sure that Claire, Logan, and any other CPAs we work with get that document in advance, and you can get organized as mail starts coming in the beginning of the year and just make a pile or a folder and quickly hand it off. But one thing you mentioned there was donor advised funds and 529s. As we were working through our sort of end of the year planning process, we've identified a lot of opportunities for clients who are charitably inclined to take action. And now we're working the next couple of weeks to get that all done. How do you think about gifting, and how do you talk about it with your clients?
Well, first off, I mean, gifting in and of itself is amazing. And while we hope people think of giving outside of the tax benefits, if you're already inclined to give, there's some super smart ways to take advantage of benefits that the law allows. So definitely donor advised funds are amazing because it lets you kind of accelerate a large charitable deduction in maybe a year that you have a really high income. So you can kind of match up the large deduction with the large income. And donor advised funds are also great because, okay, maybe you have a windfall of money right now that you want to set aside for charity, but oh my goodness, it's November. I don't exactly know what charity I want to go to. It could be almost kind of stress inducing. Putting it in the donor advised fund is a great way to just kind of sidebar it until you're ready to choose the organization you want to give it to. And it also, when it's in the fund, it can still grow tax-free. So really, you're just maximizing potentially the more gift you could give in the future. So donor advised fund is a great tax tool. Other things around giving. So even if it's not a charity, so every year for the holidays, I write a check to my nieces and nephews' 529 accounts. So it's, another form of gifting, definitely, that isn't wrapped under the tree. But when I give them that money in the 529, because it's an Ohio fund and I live in Ohio, I actually do get a tax deduction for the Ohio return. States have all different rules about that. But, my nieces and nephews are 2 and 4 years old. That money in their 529 is going to grow tax-free until they're ready potentially to use it for private education or college. Additionally, 529s, people might say, well, what if they don't go to college? Now they're able to be converted to a Roth IRA, which is like the coolest thing ever. Like so many decades of tax-free growth for the potential children in your life.
Mhm.
So
How do you give it to them? Do you wrap up a little gift?
so unfortunately, I just
$1?
put it in an envelope and give it to their parents. And right now they're young enough that they don't necessarily like realize that I'm not getting them the coolest thing.
Yeah.
So I feel like as they get older, when they're 10, they're going to be like, Aunt Logan, like you're just giving me the envelope I can't use now. But when they get older, they'll
appreciate it.
Yeah, and that's what matters.
Exactly. And Claire, you mentioned, some of the things that are on your year-end checklist, and backdoor Roths was one of them. So, speaking about backdoor Roths and also about your growing practice, I know you work with a lot of former do-it-yourselfers. We tend to see that too when we're starting to work with someone and get their financial plan organized. There's a lot of folks who've been using TurboTax or H&R Block. So what are some of the common mistakes or challenges you see people make when they're self-filing and maybe trying to do a complicated thing like a backdoor Roth? What do you guys see from your perspective?
That's
First
a
of all,
very relevant question.
Yes, we love backdoor Roths. We do them ourselves. And specifically, whenever we see a DIY tax return, we very, 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 very often see that through the tax return, it has been misrecorded. The backdoor Roth through the tax return has been misrecorded. The reason is because although we love TurboTax and H&R Block, great softwares to use, especially for the DIYers, they do not ask the right questions in order to record the backdoor Roth appropriately. And oftentimes when you are recording it appropriately, it'll throw an error. It'll say, oops, you didn't do this correctly, when in actuality you did. So my message for any DIYers out there, if you are doing the backdoor Roth strategy with Taylor's team, when you go to review your tax return after doing all of your inputs into TurboTax, print out the return, look for a form called the 8606 and read through line by line, read that sucker. It gives you instructions line by line for how to fill out the 8606 properly. Just take the extra time to review it and make sure the numbers that are represented there are correct. The downside is if you don't record it correctly, oftentimes you are not keeping record of the basis of money that you've already paid tax on that might sit in your IRA, or you are paying double taxation on dollars that you might have converted. Either way, that's not good. It means that you'll end up paying more tax in the long run, and it kind of undoes all the strategies that Taylor's team does for you.
Yeah, I would say, so part of our onboarding process for new clients is we ask for a copy of their prior year return. And I mean, we've probably just this summer amended 10 tax returns to get people thousands of dollars refunded because they did it themselves, or quite frankly, one of them was with another tax preparer, and they ended up paying tax on $12,000 of conversions that they didn't need to. So they were happy to pay our fee at that point when they were netting much more cash. Yeah. The other thing that I'll say about Roth conversions and just backdoor Roths in general, whether you're working with us or anyone, like you're in good hands with Taylor, there might be some tax preparers who are very focused on the current year tax. They might say, you're converting $50,000 this year. That's going to be a big tax impact. And if they're only looking at your current year situation, yeah, you're gonna have to pay tax this year. But someone like Taylor, who's planning with you for the longevity of your life, that says over your life, you're paying less taxes. And that's really what important tax planning is. We said it's not just a 2-month period, it's more of an annual period, but really tax planning never ends in your life. We're getting too excited.
So that was a great explanation and highlighting some of the errors related to the backdoor Roth specifically. What are some other kind of lifetime events that would sort of signal, a flare goes up, hey, this is happening in your tax life. You might have been good doing it yourself in the past, but now because of XYZ, you should consult with a CPA. What are some of those events?
Some of the common ones that we see are people getting married, having to, combine all of that. And when maybe you have children or new dependents that really bring into different potential deductions or credits. Equity compensation is a really popular one, because though it feels like, oh, it's all coming through my W-2, it's easy. There are a couple really important notations on that W-2. And most importantly, you'll probably get a 1099 that lists information that if you type it into TurboTax the way it's listed, it might not be accurate. There's some extra details they provide at the end. So that one's really common. Sometimes when people sell their houses,
if they're pursuing different student loan strategies like the PSLF, public service loan forgiveness.
Yeah. A lot of times just when there's like a change that, okay, this isn't just the same as last year. I can't just review what I did last year. They're kind of ready to, sometimes I say when people are just ready to start adulting, which could happen for some people when they're 20 and some people when they're 45. Yeah, like totally understandable. We actually had a client sign up who their life change was just retiring. And they said, I've been used to typing in my W-2. Now I'm getting a few new forms. And quite frankly, I don't want to spend the time to learn these new forms. So I'd rather pay a professional to do it. So there's all different comfort levels. So definitely if you feel uncomfortable, that might kind of just be a clue of, it might be time, it might be worth it to get a second opinion.
Yeah, very insightful. And many of those things you're talking about are things that we see in our client base. So I can absolutely agree with you on several of those points, particularly equity comp. And speaking of changes to income, a portion of the audience today were involved in a big biotech merger in 2024. And with that, we've had a lot of job changes, people dealing with irregular income like severance packages and retention bonuses. Are there any specific planning points that you would emphasize for people who are in those types of situations this past year?
Absolutely. I would say that this past year, we've worked with a lot of people going through equity events with their companies, first and foremost, to make sure that they have either withheld or have paid enough in taxes throughout the year to make sure that they don't receive a penalty when they go to file next year. The other, we were talking right before this, the other thing that Logan had mentioned was making sure that when you start a new you start a new job with new benefits, that you are withholding or you're saving enough into the 401k across both of the companies, as opposed to, saving your full Google, please, in one company and then withholding that max amount again in a second company. You need to look across both companies to make sure you're withholding that amount.
Yeah, for the retirement. And then also, if someone's going through a merger, just also, assuming that they're going to kind of have a new benefits package, looking at your HSA, if you sign up with a new payroll company, that payroll company doesn't know what happened before. So if you say, oh, I'm going to max out my health savings account, and then both companies end up doing it, you could get penalized for that. So really paying attention to those changes. But then also, again, just in terms of, speaking to the equity compensation, that could be a good time, you know, if this was a windfall event with a lot more cash, that is really a lot of opportunity to look at a donor advised fund, like Taylor said. Okay, this is really a time to look at my balance sheet, and is there certain debt that I have? Is it smart to pay it off? Is it not? You know, and that's something that a financial advisor will really help you with. You know, not all debt is bad, they say, if you can invest it for a long time, but that is super individualized. So we don't want to say, you know, do X, Y, Z, because it's probably different for each person, but it's super important to look at it with a professional. And then, so Claire was mentioning the withholding. Sometimes when these events occur, softwares or whatever you have to go through are saying, oh, do you want to withhold 22% or 37%? That's a really big difference. And again, it kind of depends on what you should choose. Sometimes you want to choose the highest one because you don't want to have a surprise later. But sometimes, depending on when the event happens, maybe you want to withhold a smaller amount, knowing, and this is where personal preference comes in, knowing you're going to have to make a payment maybe in 7 or 8 months, but saying, well, I want to put the difference of that in a high yield savings account for a while. You know, there's a lot of steps that people can be like, I want to be as advantageous about my planning as I can. And then there's some people, and this is fine too, who it's okay if it's not the most tax advantage, but I want to make sure just I have peace of mind, which an advisor can help both of those, making sure you're saving taxes and just making sure you're not stressing about it at night.
Awesome. Yeah, that's very helpful. And again, a lot of the same stuff that we see with clients. And I think one other thing that's really interesting, well, has been interesting navigating this big merger is, you know, some folks' salary was, you know, withhold at 24%, and then all of a sudden you get the equity cash out and your year-end income was so different, and you end up with a surprise, which to Claire's point could be, or to Logan's point, could be a positive surprise, or, you know, could be a negative surprise. So another thing that's really top of mind for folks is the election. You know, if you haven't gone out and voted yet, folks, make sure you vote. Very important thing, civic duty. But without getting caught up in the political weeds, you know, one thing we're talking with clients about is the potential sunsetting of the TCJA. How are you talking about that with clients today? What are some of the big changes that folks should be aware of?
This is like everyone wishes they had a magic globe, see into the future.
So first, let's talk about, on a basic level, what is the TCJA?
Smart.
TCJA.
Tax cuts and jobs.
TCJA. Yep.
TCJA.
Yes, it just, I think on the whole, was an act that went into effect that lowered taxes across the board for the most part for everyone. And it also made the filing of taxes easier for the majority of people.
Yeah, it took away, so people can either take the standard deduction, which we like to put this free deduction, or people could take an itemized deduction where it's, let's look at some of these potential items. If the sum of this is more than this free amount, I want to take the itemized deduction. So in 2017, the first year that act was enacted, the standard free deduction nearly doubled. So now people were saying, you know, I look at my charity and I look at my mortgage interest, some of the state and local taxes I pay, and I'm not getting near this $25,000 mark. I'm not going to keep track of those things anymore. I'm going to take the standard deduction. So from a tax compliance piece, not only are we looking at, hey, at the end of 2025 right now, so the start of 2026, we're looking at this act expiring. No matter who gets voted president, Congress, things have to be agreed upon for it to either, you know, be amended. Some of it might change, but right now it's set to completely expire. So again, not only is tax rates are planning to go up, the standard deduction is set to go back down to that lower amount. So that's tax rule changes, but I also want to bring it up. So that's like a habit change, right? Maybe people haven't been keeping track of their $5 or $1,000 charity checks because they're like, well, I'm not going to reach
Mhm.
this high amount. So now, even if, you're not someone who thinks about tax rates, it's back to that year-round planning,
Mhm.
keeping track, because with this big change, CPAs and tax preparers are going to be asking maybe different questions than you're used to hearing. And then back to tax compliance and planning, no matter what happens, right? So if this expires, tax rates are going to go up. Usually what I tell people is historically, tax rates go up over time, right? Inflation goes up, tax rates go up. If there are items that you can plan for now and pay the tax on when you know what rate you're in, it's a pretty favorable tax climate right now. If you can swallow it and pay some of that tax now and not have to go into this ambiguous area in the future, I would say do that if you can, and I'm not saying put all your eggs in one basket, but paying tax, like I said earlier, on an annual, like paying tax this year might not be the worst thing when you're looking over the tax landscape in your entire life.
For instance, that is perhaps work with Taylor first, but perhaps deciding to save directly into Roth accounts if you can, or doing that backdoor Roth strategy that we mentioned before.
Yeah, definitely.
Yep. And it'll be very interesting to see, what changes occur and what don't. And there's obviously a huge estate component too that I'm not going to get into today because we could talk about that for quite some time. But I think your points are great. The way that you've been organizing your financial life might have to adjust a little bit to make sure you're keeping track of all those little things. Does it make sense to accelerate the income, whether it's an IRA conversion while your brackets are large and your rate's relatively low? Accelerating equity compensation, sale of existing businesses, things like that could all potentially benefit from the current lower tax rate. So that's really insightful. Really appreciate that. Well, I just want to thank you both for being here today and sharing the Vivify story and the valuable insights with our clients and our friends. For clients in the audience, if any of the conversations today have brought up new questions, please do not hesitate to reach out. We can schedule a meeting anytime. And for folks who are not clients yet, if you'd like to get in touch with Claire and Logan, why don't you guys pull up your website again so folks can find your info. Definitely reach out to them. They're wonderful. And if you've got questions about any of your financial planning needs, please reach out to us and we'd love to connect with you.
It looks like our slide disappeared for a little bit. But our website
is
www.usevivify.com. You can Google us. You'll see our faces on the website. We'd love to hear from you. We have introductory calls that it's not like you hit that get started button on our website and you're signed into a contract. We're very much, wanting to get to know you, make sure we're comfortable before we would have you sign anything on the dotted line.
Yep. And follow us on Instagram as well.
Oh yeah, we're influencers.
At usevivify.com if you want some fun tax content.
There we go. Well, thank you both very much.
Thank you, Taylor, for inviting us.